What is going on, guys? Nick here, back with another video. Adobe is a company and a stock that I've never really bothered to give much consideration to. But the other day I pulled up the income statement and I was really impressed by what I found. But recently the stock price has experienced a pretty steep sell-off after trading sideways for about 6 months. So I thought I would go through Adobe's business and explain how it works, how well are they really doing financially, and if now would be a good time to buy shares. In 2013, Adobe made a huge and very important change to their entire business model. They announced the Adobe Creative Cloud would replace the Creative Suite. If you aren't familiar with these, the Creative Suite is Adobe's collection of creative programs like Photoshop, Premiere, and Lightworks. The Creative Cloud would still have all of the same programs as the Creative Suite, so nothing was going away. Instead, a big change was transitioning from a one-time upfront fee to a subscription-based model. They made this change to address major issues nagging Adobe and their business model. The first problem was having to charge a large fee to customers for their products. It was difficult for many customers to spend $700 to buy Photoshop CS6, which was the final version under the old Creative Suite model, or to buy the entire Creative Suite for somewhere between $1,300 to $2,600, depending on which exact version you ended up picking out. This huge price tag meant that there was a lot of pressure on Adobe to make the new version worth the upgrade. If there wasn't enough of an improvement, customers wouldn't have a reason to update. The second problem was once customers purchased the new software, Adobe would have to support these software versions for years, even as they became dated and weren't getting any additional revenue to fund the support. So this is why in 2013, Adobe announced it was going to move from the Creative Suite to the Creative Cloud. So currently, the subscription model can get you access to the entire Creative Cloud for $53 a month when you commit to a full year, or $10 to $21 a month for a single app. For customers, this meant that they no longer had to make those huge upfront lump payments to get access to the entire app, or worry about whether the new version will be worth the cost to upgrade. As long as you kept paying those $10 to $20 to $53 payments, you would always have the most up-to-date version. You also wouldn't have to worry about anybody else you're working with using an older or newer version of the program, which meant that you don't have any more compatibility issues. While $53 a month for the full Creative Cloud adds up to a lot, $636 a year, it would take 4 years to match the $2,600 cost of the old Creative Cloud, and under this new subscription model, you always have the most up-to-date version of the app. So unless you were actually waiting more than 4 years to upgrade, this actually does save customers money in the long run. Now for Adobe, this meant that they could release updates as they were made, continuously keeping the customer happy with new improvements, and they wouldn't have to deal with providing support for outdated versions of their programs that they weren't getting revenues for anymore. Later on, we'll take a look at how this changed Adobe's overall financial position. So Adobe breaks itself down into 3 segments: digital media, digital experience, and publishing and advertising. The focus, though, is on digital media and digital experience. Adobe says the third segment, the publishing and advertising segment, contains some of their legacy products. The digital media business is Adobe's Creative Cloud. These are all of their creative products like Photoshop, Premiere, Lightroom, InDesign, After Effects, and Acrobat. The digital experience business is Adobe's Experience Cloud. It's enterprise software combining marketing, advertising, customer analytics, and commerce together under the Adobe Experience Cloud. They compete against other enterprise marketing businesses like Salesforce. However, Adobe has a slightly larger market than Salesforce because they're also involved in executing ad purchases, which is a $20 billion market. Adobe estimated in 2019 that their entire available market for the Experience Cloud business is $53 billion and growing at 34% per year. Because the Creative Cloud generates significant free cash flow, Adobe has been able to use some of this cash to build out the Experience Cloud. The majority of customers using the Creative Cloud are creators and not necessarily business owners who need enterprise software. Adobe has made some acquisitions to strengthen their Experience Cloud. They bought Marketo for $4.75 billion in 2018, and they bought Magento for $1.68 billion in 2018. So let's take a look at Adobe's business and see how they're actually performing. Looking at revenue, operating income, and net income, we can clearly see the difference switching to the subscription model has made. Again, 2013 was the year that they made the big switch to the Creative Cloud, and on this graph we can see how much it's paid off for the business. Growth from 2006 to 2012 was pretty mild, especially compared with 2013 on. What also really sticks out to me is the massive profit margins that they're making. Over the past 12 months, Adobe has reported 40% profit margins with just over $5 billion in net income on $12 billion of revenue. Looking at their expenses compared with the revenue, we can see why they're able to end up with such high profit margins. Their cost of revenue has remained very consistent even as revenue has grown. Sales and marketing are their biggest expenses, much more than the cost to produce their own products. When cost of revenue is low, this usually will allow the company to have much better profit margins, especially when the company does well within their market. When we look at their segments, digital media is the biggest segment and also incredibly profitable with a consistent 96% gross profit margin. We don't always see companies this large still growing their largest segment, so to me this stands out as a very strong sign for their growth going forward. Digital experience still maintains a very impressive 62 to 67% gross profit and shows steady growth. Their balance sheet shows $24 billion in assets to $11 billion in liabilities. This gives us $13 billion in equity. They reported $4 billion in debt, so they have a debt to equity ratio of 0.3, a very healthy number. They also reported $4.4 billion in cash, so overall this is a very healthy company, which is what we would expect with the massive profit margins that they're achieving. Okay, so let's take a look at what Adobe stock is actually worth. But before I do that, if you found this video helpful so far, make sure you scroll down and hit the like button. These videos do take a pretty good amount of time to research and put together, so if you could help me out with a quick thumbs up, I would really appreciate it. So looking at the forecasted earnings, Adobe is projected to continue growing going forward, with an estimated $20 billion in revenue in 2023 and $7.3 billion in profits. They're also still projected to retain roughly 40% profit margins. When we look at this in terms of revenue growth since the switch to the subscription model, they were able to achieve just over 20% growth from 2016 to 2019. 2020 did see some slowing down with only 15% growth. Currently, analysts project the end of 2021 to show 18% growth, but then they're expecting some decay going forward. Now, I wonder if we really do see the growth fall off that's currently being forecasted. It would seem to me that if Adobe's forecasted 2019 total available market of $53 billion and annual growth of that market at 34% is accurate, then I would expect them to maintain more than 12% growth. So for this valuation, I'm going to use a top-end growth rate of 14%. Just a little above the 2023 forecasted growth rate. For the bottom end of the valuation, I'll use a 10% growth rate, just below the forecasted forward growth. This comes out to a fair PE of 22 to 32. So 2020 finished full year earnings at $10.83 per share. This gives us a valuation between $247 to $360. If we look forward to 2021, they're currently forecasted to earn $13.26 per share, which gives us a valuation between $292 to $424. For 2022, analysts see $15.43 per share, which would bring the valuation up to $339 to $493, putting the current share price right in the middle of these two numbers. Looking at this on a chart, we can visually see how this works out, with the top end earnings multiple, 32, hitting fair value sometime between 2021 and 2022. And for the bottom end, the share price wouldn't be supported by the fundamentals until 2024 and 2025. If we look at macrotrends.net, we can see how the PE ratio has changed over time. Since 2016 forward, they basically traded at a PE of 50. When placed in my PE reverser formula, this gives us an implied expected growth rate of 19%. Which makes a lot of sense when we look again at the previous growth rates. We can see as Adobe's revenue growth has decreased, the earnings multiple has come down a little. The current PE of 41 would mean an implied earnings growth rate of 16. So if we look at this on a chart, we see a pretty similar trend with a lot of the other tech giants. It's basically traded flat for the past 6 months and then dropped off with the recent sell-off. It seems like we did see a bit of a volume spike during the initial dip, but that's since trailed off. This would indicate that there may not be as much momentum to send the stock right back up to the high 400s like it had been trading in. It seems looking at the RSI and the MACD, the sell-off momentum has slowed down a little bit, and the stock is starting to recover from being oversold. To me, the stock chart looks like a stock that is going to start rising a little bit soon, but I don't see this necessarily rocketing back up unless overall sentiment in the market changes. So looking at Adobe stock, if you're considering buying, the fundamentals are pretty strong for this company. but growth is expected to slow down over the next few years. I think it's a pretty reasonable price right now if you're looking to buy, but I also think it depends on what type of return you're expecting to get. I don't see the earnings supporting the current stock price for at least another year, but it looks like a very strong company with steady growth going forward. I really see a lot of good in this stock long term. Earnings are currently forecasted to come out a week after I release this video, so some of this information may change slightly after that. What you need to consider is if their forward growth is enough for what you're looking for. Now personally, I don't own any Adobe stock, and the only reason I'm not buying any right now is I'm just looking for a little bit more growth, or to buy at a much lower price than what I currently think the stock is worth. But that's just me. Everybody else has different goals and risk tolerances. Now if you want to learn a little more about my process for researching stocks, I actually just put out a video explaining the exact steps that I take a couple weeks ago, and it's all very easy to follow regardless of how much experience you already have. I would highly recommend anybody checking out that video. And as always, thanks for watching.